Most businesses focus on selling more, but the real power is in keeping more of what you already earn. In today's global market, costs are rising, competition is intense, and margins are getting thinner across industries. In this video, we are sharing how to increase profit margins without increasing sales. Step number 1, the cost structure makeover. Most businesses don't realize their biggest profit leaks sit right inside their cost structure. The first step is reducing the cost of goods sold by negotiating smarter with suppliers, reviewing bulk purchase terms, and switching to better priced raw materials without hurting quality. The second move is prioritizing higher margin products or services so the business isn't relying on low profit lines. For example, a catering company may discover its corporate lunchboxes generate 40% more margin than individual meals. Next, lowering inventory carrying costs improves profitability because stock sitting in the warehouse burns cash through rent, insurance, handling, and damage. Smart forecasting and smaller SKU variety help control this. Finally, improving production efficiency leads to fewer errors and less rework, especially for manufacturers or service companies with repeatable tasks. When a factory lowers its defect rate from 3% to 1%, that difference directly increases margin without selling anything extra. Together, these 4 levers create a strong foundation for healthier profitability and stronger cash flow, even in months when sales slow down. Step number 2, the efficiency and automation engine. This category focuses on doing more with the same resources. Automating repetitive tasks like invoicing, scheduling, payroll, or inventory tracking can save dozens of labor hours every month. If software costing $40 per month helps avoid hiring an extra assistant costing $35,000 per year, that gap becomes pure profit. The second approach is streamlining operations by removing bottlenecks, improving communication, and shortening the time it takes to deliver work. Faster throughput means more output per labor hour, which equals higher margins. Third, outsourcing non-core activities such as bookkeeping, legal, design, or IT turns fixed payroll cost into variable project-based cost. A small business might outsource bookkeeping for $3,000 per year instead of hiring a full-time $40,000 accountant. Fourth, improving employee productivity through better training, tools, clear SOP, incentives, and reduced interruptions helps teams generate more output without increasing headcount. If productivity rises 10% across a 5-person team, the financial impact compounds quickly. Efficiency is about eliminating wasteful motion and wasted time, and for many companies, this is where profitability transforms fastest. Step number 3, the expense optimization lab. Profit margins grow when businesses spend intentionally instead of blindly. Cutting low-value expenses is the first step. Many companies pay for software they no longer use, overpriced internet plans, duplicate tools, or unused subscriptions. A quarterly expense audit often frees up thousands every year. Next comes reducing waste and material loss. Restaurants that measure ingredients, contractors that optimize material cuts, and factories that monitor scrap rates all gain margin without adding new customers. Third is optimizing packaging and shipping. Right-sized boxes, lighter fillers, and negotiated courier rates can reduce logistics costs by 5 to 20% annually for e-commerce businesses. Fourth is improving energy and utility efficiency through LED lighting, smart thermostats, insulation, and energy audits. If a shop spends $12,000 per year on utilities and trims, that by 10%, that is $1,200 of extra margin with zero added revenue. Small improvements stack up. The secret here is that expenses don't have to be eliminated entirely. They only need to be optimized. When this section is executed well, it often becomes one of the biggest long-term margin boosters in a business. Step number 4, the smart revenue enhancers. This section is about boosting profit per customer instead of chasing more customers. The first method is value-based pricing and charging for premium add-ons instead of offering endless discounts. A computer repair shop might offer same-day service for $50 extra, instantly increasing margin. The second way is offering upsells and add-ons at the point of purchase. A car wash adding interior detailing or a roofer offering gutter cleaning are simple examples that increase average order value. The third lever is using lower-cost marketing channels with higher return on investment. Email marketing, referrals, content marketing, and partnerships often produce customers more cheaply than paid ads. If a business reduces ad spend by $10,000 without losing customer volume, the margin effect is massive. Fourth is reducing returns and replacements by improving product quality and setting clearer customer expectations. Returns destroy margin due to shipping, labor, and repackaging costs. If returns drop from 8% to 5% annually, profit rises even if total revenue stands still. These 4 strategies help businesses earn more per transaction, not more transactions. Step number 5, the financial discipline framework. The final step includes simple financial discipline practices that quietly strengthen profit margins. First is standardizing processes using SOP and checklists so work is done correctly the first time. Fewer mistakes mean fewer refunds, less rework, and less wasted labor. Second is using technology to reduce labor costs through smart quoting tools, scheduling software, dashboards, and CRM platforms. A smaller, well-equipped team often outperforms a larger team with no systems. Third is improving customer retention so the business gets more lifetime value from the same acquisition cost. If acquiring a customer costs $200 and they stay for 18 months instead of 6 months, profit per customer multiplies without extra marketing spend. Fourth is improving supplier terms and payment terms so the business holds more cash, pays less interest, and operates with better working capital. Financial discipline is not about cutting everything. It is about building habits that protect margin every month. In the end, businesses that master these 5 categories learn a powerful truth. Profit is engineered internally, not earned only by chasing bigger sales numbers. Reducing cost of goods, negotiating smarter, cutting waste, improving productivity, simplifying offers, tightening inventory, speeding collections, outsourcing wisely, training staff, improving retention, and aligning marketing all combine like building blocks. None of these require more customers. They only require awareness and discipline. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.